Hello and welcome to our second segment of frequently asked questions. I'm going to be answering the most common question: is now a good time to invest? So we've talked about the market going down and coming back up again rapidly. And in that video, I showed you a slide, which I'll put up again. And in that slide, it shows 287 companies, which are making up not the entire Standard & Poor's 500, but a good segment. And you see Apple, Amazon, Alphabet, or Google, Microsoft, and Facebook, equaling about 50% of that pie chart with a bunch of other names. You've got your industrials, pharmaceutical segments of the economy. You've got retail and real estate, building and supply, and of course consumer durables and so on. Tons of opportunities in those spaces, but everybody right now is just focused 100% on tech. And that is, of course, in your portfolio. So I want to reassure you, we've got a segment of that in the portfolio, but we're not overweighting that in portfolios to the detriment of the other opportunities. I want to talk to you for a second and just if we go back to 2008 and we think about what happened there, we saw Canadian banks, because it was a credit crisis, drop 50%. Well, maybe you've never thought of this, but the remaining 50% needs to make 100% to get back to even. And we're looking at, Canadian banks today, and I can tell you, I believe they're going to have a more difficult time this time because some of the problems are more real and will more or less affect them. Whereas in Canada, we didn't have as much. I think it was the CIBC was the most hard hit. TD Bank, for example, didn't have any commercial paper in 2008 that was of the variety that went bankrupt, and so they were great. And it just took the market a little time to realize that, and immediately people made 100% if they bought into those stocks at the right time. And we're going to see some of that again, but I believe it's going to be over a 2 and 3 year period. I don't think banks are going to post great earnings this year. I think they're going to be struggling a little bit with, they're going to have to keep larger amounts of cash on hand for potential defaults. In my previous video, I said there is a risk that we go from unemployment numbers to bankruptcies, where the businesses that those people were employed in are no longer in existence, and so they're not going to be able to hire them back. I think it's going to be on the smaller business scale. Certainly anything of any size is going to make it here. Most companies have had pretty good reserves going into this. The good news is the economy was strong as COVID hit, and so many companies had war chests full of cash, and that is going to see them through. We're going to see a big problem. We're going to face it in July when the second quarter, April, May, and June are all going to be reported in July, and that's going to trigger some market shakiness. So is it a good time to invest? Absolutely. I would put some money in now, and what we were doing with clients is they're sending us cash. We're holding on to it, and we're just timing it into the market. Not timing, but adding it into their portfolios on a scheduled basis, so either once a month or once every week or 2 weeks. And in some cases, it's just sort of ad hoc. They send us cash when they feel they'd like to put it in. And the best time to buy is when the market has a bad day, not the day that everything goes well. And you have to think opposite to what is sort of intuitive. What makes you feel good is an up market, but what gives you the opportunity is this down market. And so there are many, many things in there. And let me speak for one other second about passive versus active. We employ an active, by and large, an active process. We do have exchange traded funds as tools within our portfolios, but we're not buying clients directly into ETFs as an investment. They were designed to be tools in the hands of money managers, and we believe that that is the best place for them, that they should be accessed when needed. And so right now it is a stock picker's paradise. You know, it's a bond manager's paradise to be buying the right things. You know, if you're looking at investment trusts right now for real estate, it's a great time to be selective. You don't want to be owning everything because you're going to have some issues. I mean, apartments are going to do better than potentially some larger real estate holdings, such as office buildings. We just heard from Google and most recently Shopify. They're going to be continuing with stay-at-home forever. You know, their goal is to turn themselves into a virtual company where most of their workers work from home, and that new normal may take hold in a lot of other industries. So short term, there's maybe risks in certain areas of the economy. In other areas, not so much. In fact, they're great opportunities. And in other areas, it's going to just take 1 to 2 years for us to see that resurgence. So we're buying that into those opportunities right now. That's what money managers are doing, and that's what we think you should be investing your capital in right now. The other segment, let me just quickly say, are bonds. And bonds are going to be later stage recovery. So in a lot of portfolios, we saw, you know, maybe a third to 40% of the portfolio went down because of bonds. And bonds are going to return all of that value. And, you know, to date, they have returned only a very little bit of that. So what the good news is, there's some I would call it pregnant gain that is just due back into portfolios on top of the stock market gains that we're getting right now. So in the end of the day, actually could come out of this looking not too badly, but we're going to require a little patience. I would definitely recommend investing. I would actually recommend that if you have capital on the side that you'd like to deploy and you think, hey, maybe I missed it, is just talk to us, and we would recommend adding money on a monthly basis right now. This is a great time to dollar cost average, the best way to invest. Look at lots of companies out there. We mentioned banks, but just quickly, even Berkshire Hathaway, as we speak, is down 25% from its high. And there's some great companies. That's basically a U.S. Equity mutual fund. That's what Warren Buffett runs. It's probably more focused than many, but it has outperformed the Standard & Poor's. But right now, it's down 25%. That's being purchased right now by money managers. I've had several of your money managers say to us, you know, we always would like to have owned some Berkshire, but it's always been too expensive because it's been outperforming for so long. Now is a great time, and they've been buying it. So, you know, when you put your capital into the portfolios that we run, you're buying segments of great businesses, and that's what works. Thanks very much. Have a great day.